Hey everyone, this is Adam Thomas here. Welcome to the member video for SkyviewTrading.com. So just now I opened a few spreads in FDX, and you can see FDX has just been rallying like a bat out of hell. And if you look at a monthly chart, I mean, that's just a super extended move. How could you not sell something like this? So obviously I'm bearish on the stock. That doesn't mean you have to be bearish, but I'm going to show you the strategies I'm using to complement my bearish bias while still collecting premium and capitalizing on this high implied volatility rank. So let's go back and see what I have here. First, I entered a 135 by 140 call spread in December. So if you were going to enter this order, that means I sold the 135 call and bought the 140 as protection to define my risk. So you can just right click, sell, vertical, and here's the order entry right here. On that trade alone, I entered at $1.71. It's a $5 wide spread. So my max risk on this trade is about $330. In conjunction with this spread, that's a simple spread, it's a simple vertical credit spread. The max risk is basically the width of the strikes minus your credit received. Your probability of success is basically the credit received divided by the width of the strike. So really, we collected a third of the width of the strikes, and the inverse of that is 2/3. So basically we have a 67% chance of success. And that's a ballpark number because, it's just a quick, easy, down and dirty way to calculate your probability. But obviously we combine this with another trade, so our probability of success on this entire trade isn't going to be 67%. So that's what I'm going to try and do with you in this video, show you an easy way to calculate your probabilities whenever you have skewed iron condors and all kinds of different trades. Because basically it all comes down to where your break even is on the trade. So let me just show you the other trade I have here. So in conjunction with this 135 by 140 call credit spread, I sold a skewed iron condor, and I'll bring up the order here to show you. So just right click on the 135 call, click sell iron condor, and if you look at our position here, you can see the put strikes are 125. Well, we'll do this long strike is 120, 125, and you can see for this iron condor, this is just a regular iron condor, it's not skewed. You could collect a credit of $2.66. Now to skew this to the bearish side, meaning I want to give this negative deltas because I'm bearish in FDX, I widened the call strike. So instead of selling the 135 by 140, I sold the 135 by 145. So you can see we have a 10-point wide call spread combined with a 5-point wide put spread. Now let's take a look at how we can calculate our probabilities of success on this entire trade, because obviously we have quite a bit of options here. So let's go to the Analyze tab. This is a quick, easy way to calculate your probabilities. Now down here at the bottom you can see our positions are checked. Probability date at the top, we're going to make sure this is on the December expiration, and I always do this on the Saturday after the expiration. That's just how this Analyze tab kind of works. So what you're seeing here is just our P&L graph, and focus on the red line. This is our P&L at expiration if we were to hold this all the way till expiration. So the x-axis is the stock price, the y-axis is your P&L. So if we take a look here, and I'm going to set slices, break even, and I'm going to select the expiration date. So you can see we don't have a break even to the downside. Most iron condors have two-sided risk, but on this trade, if we go down, we have no risk. You can see we'll actually make $43 no matter where we go to the downside in FDX. So if we go to 0, our put spread is going to lose money, but we're going to make more money on the two call spreads that we have than we lost on the put spread. So that's why this is a skewed iron condor. Now you can see our break even is 137.73 cents, and I can add another slice here, and this is the current stock price, 133.04. And actually I'm going to remove this just for now. Right click and delete slice. So you can see we have one slice here. We have 137.73. So if we stay anywhere below 137 and 73 cents, we're going to at least make 1 penny on this trade. If we go even lower than that, you can see our max profit is $543, and if we go down, we're going to make $43. So basically how you can calculate your probabilities on any trade is just set your slices, break even, and you can see where your stock needs to stay in order for you to make money. And then up here in the probability mode, make sure this is checked to probability in the money. You can also do probability out of the money too, but I always use in the money. So it's the same thing. It's just the complete inverse. So I just always use in the money because that's just what I'm used to. So you can see here, this 65.69%, that's the probability that FDX will stay below our break-even price. So therefore, that's our probability of success on the trade. This 34%, that's just the probability that we will lose money on the trade. So taking this one step further, we can calculate our probability of max profit, which is obviously going to be lower than our probability of breaking even. But the way we can do this is we can just add slice, and I'm going to set this slice to our short strike of 135, and then I'm going to add another slice, and we're going to set this one to 125. So that's the range we need FDX to stay in to make max profit. So you can see our probability of making max profit is basically 30%. So alright guys, hope that made sense. If you have any questions, just shoot me an email and I'll gladly get back to you. Peace.